Hi there everyone, a very good evening and welcome to the Money Show right here on ET Now. I'm Avan Dabash. This is the one and only show of its kind that answers all your personal finance queries. With me over the next half hour, we have Mr. PV Subramanyam. He's CEO Subramani.com. I encourage all of our viewers to ask any questions or queries. Our phone lines are open live, so you can dial into the number that's at the bottom of your screen or simply email us on the Money Show at etnow.tv. Well, let's get things started and start off with a bit of an interesting discussion topic, Mr. Subramanyam. In terms of the right way to measure risk, there's all, we have a lot of tools, the standard deviation, Sharpe ratio, etc. But what is your advice?
See, the risk in any product lies in your head. Okay, it's not in the paper lying in front of you. I can measure everything, but please realize all this is past data. What is going to happen in the future is something which none of us know. So, if the market falls 20%, it looks very easy. I tell you, look, you've invested 10 lakhs, market falls to 8 lakhs, what will you do? And you will say, oh, it doesn't bother me. The question is not what you say, the question is what you do. So, the risk is when the market falls or when standard deviation hits, how you react, that is the risk. Not the theory of how you should react. Like, I mean, the example is, if I tell you if a tiger comes, just stand still and nothing will happen to you, but that's fine, that's theory. When the tiger comes, what you do depends, and that will decide your fate, right? So, how you react to the standard deviation or you react to a 20% fall or a 25% fall, you are supposed to stay calm. Question is, can you stay calm? Maybe you stayed calm when you were 25, can you stay calm when you are 65? Those are the things which decide your return, not just a theoretical number of a trainer ratio or a Sharpe ratio. Those things don't really matter.
Okay, so it's more mind over matter is perhaps the point that you're trying to bring across. Well, let's get those questions and queries answered. We've received quite a few of them, and as I told you, our viewers, we have Mr. PV Subramanyam with us over the next half hour. If you've got any personal finance queries, please do call in on the number that's at the bottom of your screens. Well, let's get straight to it. S. Rupchand has sent us an email query. He says, I am retired and currently in the 20% tax bracket. I have invested in HDFC Midterm Opportunities Direct Growth Plan in 2 installments in order to save tax. At the time of the investment, the fund's gain stood at about 9%, but currently the returns have dropped to less than a liquid fund, which is less than 6%. Please advise if I should switch to a reliable or a safe AAA rated fund instead. What advice would you have for him?
I'm a little confused. This is not an equity linked saving scheme. So, it is not something where you could have really saved tax in that what you mean. But yes, by staying on in this fund for a long period, you save capital gains tax because capital gains tax applicable to you. First, 1 lakh is tax free if it is long term. So, yes, that is good. Secondly, comparing a equity fund, that to a mid-cap equity fund to a debt fund giving 6% assured returns is wrong, because 1 year of 9% in mid-cap opportunities can be followed by a 4%, followed by a 23%. You're never going to see a 23% in a liquid fund. So, decide on what you want. In your overall portfolio, you should have some liquid funds, some other debt funds and some equity fund. This is to be compared to an equity fund. Yes, mid-caps are not doing well now, but to think that it will always give you at least 6% or at least 9% is wrong. You have not understood standard deviation. Equity returns will be good. Equity returns will definitely be better than a liquid fund over a long period of time, but there will be some periods of time when it underperforms liquid. It can even give you negative returns. So, please be ready for that. Please understand what you're doing. Don't compare this to a liquid fund. It's not fair. You didn't compare it to a liquid fund when the returns were higher than 6%. When it was 9%, you had fun. When it is 3%, you'll have to bear it.
All right. I hope you've taken note of the advice that's been given by Mr. Subramanyam. Let's move on to our next query, and this one has been sent in from Kamal Kshetrapal. He says, I too am 61, I'm retired and I have an SIP of 2,000 rupees per month in SBI Magnum Midcap Regular Growth Fund. He wants to open one more SIP. 3,000 rupees is what he wants to invest over the next 10 years. Which fund do you advise? So, let's get in a view, Mr. Subramanyam, as to how you're looking at the SBI Magnum Midcap Fund And what advice do you have for someone who's retired, who's looking to invest an amount via SIP and mutual funds?
Yeah, I don't know. I mean, if you're 61, you could still take a 20-25 year kind of view on the market. So SBI Midcap is definitely a good fund. It's nice for you to stick around with that. I don't know what are your other funds in which you have invested. If you have not invested in another large cap fund, you must get into a large cap fund, which could be a Franklin India blue chip or a HDFC top 200 or any of those large cap funds which are big amounts. That is where you should get into. I am assuming the only other fund you have is this, which is a mid cap fund. So, you should get into a large cap fund, or maybe you should get into a multi cap fund, but that might overlap with this. So, I would suggest your large cap fund. Maybe even just an index fund could be good enough for you, because over a 10-year period, maybe an index fund will outperform even a Franklin India blue chip or an ICICI blue chip.
Okay, I hope you've taken note. Those are some of the funds that have been advised. Motilal Oswal Multi-Cap 35 Fund, Franklin India Prima Plus, as well as what you can send, what you can invest in. And of course, Mr. Shetupal, if you want to send us your entire portfolio, you can get expert advice on the same. Feel free to email us on the Money Show at etnow.tv. And guys, our lines are open. If you have any personal finance related questions on tax, on mutual funds, insurance, please do call in and we will connect your call live, giving you expert advice. In the meantime, let's get on board our next email query, which has been sent in to us by Samir. He asks, what is your expert view on DSP Mid Cap and DSP Small Cap Fund? Give us a sense as to how you look at the fund house. And also, Mr. Subramanyam, you know, since you've spoken about a good team, a good fund manager, how important is it for one to look at the quality of the fund manager while investing in a mutual fund? And go ahead with your recommendations.
It's very difficult to really find out the true quality of a fund manager. You can only look at the results and say, oh, this is good. Unlike a cricket scorecard, you really do not know how much each person has contributed. DSP as a house is definitely a good house. They have a very good team. They have a risk team. So, definitely they have had a good fund manager. They have got a good fund management team. They have seen some losses at the top, but I don't think that is too much of an issue to worry about. A mid cap and a small cap fund, definitely it is a good fund. It was performing very well. Then they stopped accepting. Then the performance deteriorated. But over a 5-year, 10-year period, if you want to have a look at it, it is definitely a good fund. There is no reason to get out of it. Does GSP have a good team? I think so. I met some of those people, and some of those people are really good. They have a good risk team. They have those things in place. Most of the fund houses have these things in place. What you see is less like a movie. What you see is just the stars, right? You don't see the script writer, you don't see the director, you don't see the musician, you don't see any of them. So, you just see the fund manager. There's a big team working behind that, and I think all of them have a good, decent team in place. So, I do think it's a good fund and you should stick around with this fund.
Okay, so clearly, you know, it doesn't assume importance in terms of the fund manager, but you can look to stay invested. This is a good fund despite the kind of blip that you've seen in the performance of late. Well, we have a live caller from Kolkata. Gautam Mukherjee is with us on the phone line. Let's answer his personal finance question. Welcome to the show, Gautam. What's your query?
Hello, good afternoon, man. Actually, I want to ask, sir, that about 7.7% government RBI bond. I want to ask, is it secure like FD of any nationalized bank or MIS in the post office? I want to ask this question to this.
Mr. Subramanyam, did you understand the question?
Yeah,
okay.
Yeah, see, any instrument coming from post office, RBI, I would put State Bank of India also in that class. Your money is safe. Yes, your principal is safe. Yes, it can give you a return which is less than inflation. So, therefore, you can get a small negative return, but is your principal safe? Yes, your principal is safe. Yes, 7.75 is what you will get. You get approximately that much even in an LIC's pension plan. Yes, you get a slightly lesser rate, but your principal is safe. Principal is safe in the sense if you put $100, you will get back $100 for sure.
Okay, I hope you've taken note of that advice. Mahindra is with us on the phone line from UP. बताइए साहब, आपकी query क्या है?
I want to invest in mutual fund.
Sir, how old are you and what is your time horizon?
My age is 65.
Okay.
I have no time, especially. And I want to monthly dividends.
Okay. So, would you describe yourself as a fairly risk-averse investor? Not very risky?
Moderate risk cover, thoda sa.
Is there anything else you would like to ask him about, Mr. Subramanyam, before you give him advice?
Yeah. Have you ever invested in any equity at all, ever?
I invested ICI Prudential Monthly Dividend Fund,
Okay.
HDFC Prudence Monthly Dividend Fund.
Okay.
And now he wants to put his money in more mutual funds. What would you advise him to do? How do you rate his portfolio so far? And what's the call, Mr. Subramanyam?
Okay, sir, let me start by saying monthly dividend is not a good reason to ever invest in a mutual funds. What mutual funds have told you is a big lie. When they give you a dividend, it should not be called a dividend, it should be called a distribution, because the money that is coming to you is not only from the earning, it can even come from the capital. Let us assume for a minute you said you have invested in HDFC monthly income plan. If you have invested 100 rupees and they pay you say 1 rupee per month, which is about 12% per year, it does not mean that at the end of the year you will be left with 100 rupees. You could be left with 95 or 97, which means 3 rupees has come out of your principal. So what you should be doing is you should be putting money into something like a post office scheme or a bank scheme for your monthly income requirements. Some portion of your money should grow too, because you're 65, you may live for another 25-30 years. Longevity is an issue. So if you live till 90-95, you need to be worried about inflation. So a small portion, maybe 20% of your money should be in equity mutual funds, maybe the same income plans, but you should not go for a dividend plan. Dividend plans are now also taxed at extra 10%, which you don't want to pay, right? So what you should do is go and put money into maybe the same funds, but take the growth option, and in case you need to withdraw, start withdrawing after 3, 4, 5 years. After that, it will be taxed at a lesser rate. 3 years is the minimum period, after which you will be taxed at a lower rate. So you are 65 now. My suggestion is you take 20% of your money, put it into these mutual funds and start withdrawing from it from your age of 75. So 10 years, don't touch it, let it grow, and after that you start withdrawing maybe 1% per month on a basis called systematic withdrawal plan, SWP. Dividends is a terrible option. It was anyway a bad option. The government has made it a terrible option by putting a 10% tax on that. So even if you are on a zero tax bracket, you pay 10% tax. If you are on a 30% tax bracket, you still pay 10% tax. I am assuming you will not be on a very high tax bracket. So makes no sense. Don't take any of the dividend options, immaterial of who tells you. Fund houses have been bluffing about it. SEBI has a very important role to play. They should not be calling it dividend, they should be calling it distribution, because it's part of your capital also, which is coming back to you. If you didn't know this, please go back and check. Some of your capital may have come back to you as dividend. So that's a dangerous ploy. Don't use the dividend option at all. Never ever.
I'm so glad that you've been so vehement in stressing upon this, because like Mr. Prasad, there must be other viewers as well who have put their money in this, and sometimes it's important to get advice not only on what to do, but what you absolutely should not do.
Absolutely.
So I hope you've taken note of the call. We have another live caller. Before we take that break, let's get on board. Vaidyanathan, welcome to the Money Show. Vaidyanathan, what's your question?
Hi, good evening, Mr. Subramanyam.
Good evening.
Good evening,
Good
sir.
evening, sir.
My name is Vaidyanathan. I'm calling from Thane. I got a quick question for you, sir.
Go
Yeah.
ahead.
I got about 25 lakhs to put in for the next couple of months, for say 6 months or something. Could you suggest a few mutual funds where I can put in?
Are you a first-time investor? What's your time
No,
horizon?
I'm a retiree. I'm 66 years old, and I was an RA earlier, so I just came back. Okay?
If you are anyway an equity investor, I would suggest that you should be putting some money into equity. If you don't want to put money into equity, you could put into some liquid funds, and maybe after 3-4 months, whatever you want to do, you could start in putting money into equity funds, or you could put money into a liquid fund and start doing an STP. I need to know your full portfolio to be able to tell you what to do. So I think putting money in a liquid fund and then thinking what to do is a better sense than keeping 25 lakhs unnecessarily in a savings bank account.
Okay, so why don't you, Mr. Vaidyanathan, take the time out, write a nice detailed email to us on the moneyshow@etnow.tv. We promise to get it answered for you tomorrow on the show. On that note, let's take a quick break, and like Mr. Vaidyanathan and all our live callers, if you have any questions or queries, you want to realign your portfolio, you have doubts regarding your investments, you're not getting the desired returns, I'm sure you have lots of questions and queries. Sharpen your investing skills, get more clarity. by emailing us on the Money Show at etnow.tv, tweeting to us on @etnowlive, and we have a call number as well that you can dial into. So please send us your live calls right now on the show. Welcome back. You're tuned into The Money Show. We have Mr. P.V. Subramanyam of Subramanyam with us, and he's answering all your personal finance queries. Well, let's get to our next topic, where we get a review of a particular fund in great detail and what our expert makes of it. So today's fund that we will be assessing on the fund review segment is the L&T Hybrid Equity Fund. Since its launch, Mr. Subramanyam, it's generated about a 14% return and has assets worth about 10,500 odd crores. Start off with, what's your rating on 10 and how would you assess this fund? Who is it appropriate for?
I would rate it on a 8.5, 9 kind of a thing on a rating of 10. I would like them to drop expenses further, because as the size grows, the fund house makes money on that. It is a rockstar fund, and let me go back to its original name. The original name is L&T Prudence Fund. I mean, okay, there were many Prudence funds. L&T Prudence Fund is a 10,000 crore fund, as you just saw. It's a great fund. It is about 65 to 70%, maybe 72, 73% on equity, and the remaining is in debt. On equity, they don't take too much risk. It's a large cap. Not that large cap cannot do well, but it is a very predictable, no surprise, no shock kind of a fund. You will not find it a heavily mid-cap oriented kind of a thing. It does not have too much of a value orientation. It has some high growth, but it's got some good shares like HDFC Bank, Larsen & Toubro, Axis, and good portfolio. And its debt portfolio is made up of government and short-term bonds. So you'll have 2 year, 3 year kind of bonds. So there's not too much of a duration risk. A good fund, if you have got only one fund in which to invest, in which you're going to stay for a long time, 10 year, 15 year kind of a thing, it's a good fund, but please treat it like an equity fund. All these funds with 75% in equity, for all practical purposes, is equity. Don't call it a balanced fund. It's not a balanced fund. Of course, it's called a hybrid fund. Earlier, it used to be called Prudence. Prudence was the name. Yes, it's a rockstar fund. I think it's one of the flagship funds of L&T Mutual Fund. Good fund. Stay in it. If you're invested, stay in it. Take a 10-year kind of review. Don't take a 2-year, 3-year kind of review.
All right, there you have it. That's the advice coming in, and 8.5%, 8.5 on 10 is the rating coming in. But he's spoken about who it's more appropriate for and how really you should be treating this fund. Well, we have our phone lines buzzing with lots of questions and queries. So let's connect with Jimmy Vora. He's with us on the phone line from Mumbai. Welcome to the show. What's your query?
Hi, Mr. Subramanyam. How are you?
Good, good. How are you?
Fantastic. What is your recommendation for a direct equity mutual fund or an SIP into direct stock? What would you recommend?
That's an interesting question. What's the call?
I would recommend a SIP into an equity fund. Because the size of the portfolio, for 5,000 rupees, you can invest in 30 to 80 shares, which you cannot invest on your own. And secondly, what happens when you do an SIP into equity, the number of equity scripts that you have to pick up every month is pretty high. It is pretty painful and almost impossible to do it regularly. So unless you have something like 20 lakhs or 15 lakhs to invest every month, you cannot really do a sensible SIP. You pick up a few shares, you keep buying, then when it falls, you have no clue what to do, and you are building a portfolio is difficult. Portfolio construction is difficult. How will you keep pace with what is happening in the BSE? What weightage will you give? It's little difficult. You start with this. Along with this, you also build an equity portfolio, for which means you buy 1 share or 2 shares a year. Over a 20-year period, you build a 40-share portfolio. That's good. And keep comparing. If you are performing better than the fund manager, go and create your own portfolio. If your fund manager is performing better than you, put more money into his fund. I think that makes sense. Keep comparing. How are you doing vis-a-vis the fund manager? If you are getting 12% return and the fund manager getting you 18, 19 or 14, whatever, if he's better than you, put money there. If you are better than him, put money in your portfolio. That makes sense. No, there's no this or that, because I mean, people have created wealth by going into direct equity. You have to just have some patience and some ability to learn. Once you do that, you should be able to do it. But straight off the bat, SIP in a mutual fund, start learning and start picking up 1 or 2 shares every 6 months. That makes more sense.
All right, so it's a call that you really need to take based on the kind of returns that you're generating and the kind of investor as well that you are, Jimmy. If you have any, specific mutual funds that you would like to ask us about, please do email us on themoneyshow@etnow.tv. Next up, an interesting question. Venkat has sent it into us. I've invested 2.25 lakhs in HDFC Long-Term Advantage Fund Growth Plan last year. He asked, what are the prospects and is there any better alternative? But now you spoke about, Mr. Subramanyam, of this fund being merged. Give us a little bit about the background and tell us what you make of it.
See, what happened was HDFC took over another fund house. I think it was Zurich. So what happened was Zurich had a tax saving scheme and HDFC had a tax saving scheme. So this was, if I am not wrong, this was a Zurich long-term Zurich was a Zurich tax saver fund and this was a HDFC long-term equity advantage fund and this was also an ELSS. SEBI said every fund house can have only one ELSS scheme. So this has been merged into the tax saver. So this fund is no longer available for you to invest. If you were invested in this money would get merged into a HDFC tax saver. I'm surprised that somebody has put 2.25 lakhs in an ELSS fund because the maximum deduction that you can get is only for a contribution up to 1.5 lakhs. Why would somebody have invested in this? I don't know. It's got a 3-year lock-in, and if you have just invested last year, then you have no choice but to stay on in it for 2 more years, and only after that you will be able to remove. HDFC Tax Saver is a good fund. It will get merged. It will be under the same fund manager. So I don't think it is bad. And whether good or bad, you got to stick around with that for at least 3 years, and after that you have a choice. This is a good fund, so stick around. Nothing wrong with sticking around with that fund.
Thumbs up there coming in. But you know what, since we're getting so many questions from retired people, I have a question for you in terms of saving up for retirement. And do you think a 40-year-old investor should invest in equity if they're saving for his or her retirement?
Yeah, good. Avan asked, saving up for retirement. I think that word is gone. Saving for retirement is not a terminology people less than 40 or 50 can use. You got to invest for retirement. Okay. Earlier you could save for retirement because people worked till 60, promptly died at 62. That was great. But today if you lose your job at 50, your corpus has to feed you till you're 85 or 90, and
with
that is
prices
scary.
Only going higher and higher.
Absolutely, and that is scary. I don't know, it's very nice to say it's a young country, but it's a young country with a lot of old people. Right. So when you get old, that money has to stretch. So you need to be in equity. Yes, in equity you start at the age of 24 maybe, or at the age of 23, 22, whenever, and you start putting money in equity, and you have to be in equity even at the age of 70. So this myth of I am saving for retirement has to go. It has to be investing for retirement. So investing always happens in assets which are volatile, which is like say equity or real estate or things like that. So if you're going to save 5,000 per month or 10,000 per month or 15,000 per month, because at the age of 40 you've got a lot of other priorities. You got children, you got vacations, you got a bigger car, bigger house. When you have all those priorities, you will have lesser amount of money available to be put into a separate retirement kitty. So yes, if you're 40 and you're saving say 4,000 a month or 5,000 a month or 10,000 a month, it has got to go completely into equities. At the age of 60, you try and say, now let me put some money into debt also, because you have to still worry about inflation for the next 20, 30 years. So all you youngsters, when the market goes down, be happy because you're going to get more units. Don't put on a sad face because the market has gone down. When the market is down, you should be happy, you're going to get more units, put more money. You should want a boom only when you're 85.
Absolutely.
Not
so
when you're 40.
Use those opportunities.
Use those opportunities when you're 40, you should put money in equities.
As you say. Okay, Mr. Subramanyam, lovely having you with us. I'm afraid we're completely out of time. To all the people, I have received your queries. We will get them answered tomorrow on The Money Show. We're completely out of time. Please keep sending in your questions.